Let me tell you about two women who grew up on the same street, same neighborhood, same public school, same starting point in life. Their names were Ashley and Morgan. They graduated college the same year, landed their first real jobs within a few months of each other, and both started earning around $52,000 a year. If you had looked at the two of them side by side at 23 years old, you would have said they had basically identical futures ahead of them. But here is where their stories split. Ashley did what most people do when they get their first real paycheck. She upgraded her apartment. She got a nicer car. She started going out more because she finally felt like she could afford to. She treated herself to the wardrobe she had been putting off all through college. And every month, after all the bills were paid and the weekend was over, she told herself she would start investing soon. Just not this month. This month was a little tight. But soon. Definitely soon. Morgan did something different. Not dramatic, not extreme. She did not move into a tiny apartment and eat rice and beans every night. She did not give up her social life or stop enjoying her money entirely. She just set up a $200 automatic transfer from her checking account to a brokerage account on the first of every month, before she could see it, before she could spend it. $200. That was it. And then she basically forgot about it and went on living her life. Fast forward 35 years. Ashley, now 58, is still working. She has to. She has a decent lifestyle, a closet full of stuff, some genuinely good memories, and about $47,000 sitting in a retirement account. She is stressed in a way she cannot fully explain to the people around her. It is this low-grade, constant anxiety about the future that has been quietly living in the back of her mind for years now. She keeps telling herself she will figure it out. But the math is getting harder and harder to ignore with every birthday that passes. Morgan retired at 57. Her $200 a month, which she gradually increased over the years as her income grew, turned into just over $1.1 million sitting in a diversified index fund portfolio. She did not pick individual stocks. She did not time the market. She did not obsessively follow financial news or stress out about every Federal Reserve announcement. She just kept the habit going, month after month, year after year, through bull markets and crashes and recessions and everything in between. One habit. 35 years. The difference between financial stress and financial freedom. That is what this video is about. The money habit that quietly creates millionaires. And I want to be really clear about something right from the start. This is not a video about getting rich quick. This is not about some secret strategy that wealthy people are hiding from the rest of the world. This is about something far more powerful and far less exciting than that. This is about the single most boring, most consistent, most underrated wealth-building behavior that exists. And by the end of this video, you are going to understand exactly why it works, why almost nobody actually does it despite knowing about it, and how you can make it so automatic in your own life that it runs quietly in the background without you ever having to think about it again. Here is the misconception I want to address head-on right now, because it is the belief that keeps most people completely stuck. Most people think that becoming a millionaire requires some kind of dramatic event, a big break, a hot stock tip, a business that suddenly takes off, a windfall inheritance. Something exceptional that happens to exceptional people who either got incredibly lucky or were incredibly smart at exactly the right moment in time. And because most people are out here waiting for that exceptional event to arrive, they do absolutely nothing in the meantime. They watch from the sidelines. They wait. They tell themselves they will get serious about money when the time is right, when they are making more, when things settle down a little, when life gets less complicated. And the entire time they are sitting there waiting, the most powerful force in the entire financial universe is sitting right in front of them, completely available, completely accessible, not requiring any luck, any special knowledge, any perfect timing, or any extraordinary circumstances whatsoever. That force is compound interest. And the dramatic event is not coming. The dramatic event was always just going to be time combined with consistency. Here is what the financial industry consistently gets wrong in the way it talks about all of this. They present investing as something deeply complex, something that requires extensive research, careful analysis, perfectly timed decisions, and a sophisticated understanding of market dynamics that takes years to develop. They surround the whole thing with jargon and competing opinions and conflicting charts until the average person feels completely unqualified to even participate. And so the average person opts out. They hand their money to someone else to manage, or they just leave it sitting in a savings account earning almost nothing, or they simply spend it, because spending at least feels good in the moment, even if it does absolutely nothing for their future. The truth is almost embarrassingly simple. The single most reliable path to long-term wealth is not intelligence. It is not timing. It is not picking winners before everyone else does. It is consistency. Showing up every single month with the same behavior regardless of what the market is doing, regardless of how the economy feels on any given day, regardless of whether you are feeling confident or terrified or just completely checked out. Consistency over time is the entire strategy. Everything else is noise. And yet, that simple truth gets drowned out constantly. By the headlines, by the people on social media showing off their trading gains and making it look effortless, by the cultural obsession with fast money and instant results that make slow, steady, quietly compounding wealth feel like it is not even worth paying attention to. It is worth paying attention to. It is worth building your entire financial life around. And here is the data to back that up completely. Let's get into the actual numbers. Because this is not just a philosophy conversation. This is a math conversation. And the math here is genuinely jaw-dropping once you sit with it long enough to let it land. If you invest $300 a month starting at age 25 in a basic S&P 500 index fund earning the historical average annual return of approximately 10%, by age 65, you will have accumulated just over $1.9 million. You will have personally contributed $144,000 of your own money over those 40 years. The remaining $1.76 million will have been generated entirely by compound growth. You did not earn that extra $1.76 million by working harder. You earned it by starting early and staying consistent. Time did the heavy lifting. Now here is where it gets really interesting. If you wait just 10 years, if instead of starting at 25, you start at 35, and you invest that same $300 a month at the same return, you end up with approximately $678,000 by age 65. That is still a meaningful number, but it is $1.2 million less than the person who started a decade earlier. Same monthly contribution, same rate of return, same end date. The only difference is 10 years of consistency at the beginning. That is the cost of waiting. That is what "I'll start soon" actually costs you in real dollars. And then there is the data on what happens when people try to be clever about it. A famous study by Dalbar, which analyzes investor behavior over long periods of time, consistently found that the average individual investor significantly underperforms the very funds they are invested in. In one 30-year study period, the S&P 500 returned an average of around 10% annually. The average investor in that same period earned closer to 3.7%. Same market, dramatically different results. The gap was not caused by bad fund selection. It was caused by behavior, by people jumping in and out, by people selling when the market dropped and buying back in after it recovered, by people trying to time something that has never been successfully timed on a consistent basis by anyone. Morgan did not do any of that. She just stayed in, automatically, consistently. And that single behavioral decision is worth hundreds of thousands of dollars over a lifetime. A 2023 Vanguard study found that investors who made zero changes to their portfolios over a 10-year period outperformed investors who made frequent adjustments by an average of 1.5% annually. That might sound small, but over 30 years, 1.5% annually on a $500,000 portfolio is the difference between $500,000 and over $700,000. Doing nothing, on purpose and with discipline, is genuinely one of the most profitable financial strategies available to everyday people. And according to a Federal Reserve report from 2023, the median retirement savings for Americans between the ages of 55 and 64, people who are right on the doorstep of retirement, is just $134,000. The median, meaning half of all Americans approaching retirement age have less than $134,000 saved. In a country where the average retirement lasts 20 years and healthcare costs alone can run into the hundreds of thousands, that is not a crisis on the horizon. That is a crisis that is already here, playing out quietly in millions of households right now. The habit that Morgan built at 23 is the exact habit that most people never build. And the gap between those two outcomes is not talent, and it is not luck. It is one decision, made early, and then repeated automatically forever. So, how do you actually build this habit in a way that sticks? Not just in theory, in real life, with real human psychology working against you at every turn. Let me give you the rules, not suggestions, not tips you try for a week and forget about. Rules, the kind you internalize and live by. Rule number 1. Make the habit automatic before your brain has a chance to negotiate with you. This is the foundation of everything. The single biggest reason people never build consistent investing habits is not that they lack motivation, it is that they rely on motivation in the first place. Motivation is unreliable. It shows up strong on Monday morning after you watched a personal finance video, and it is completely gone by Thursday when you had a brutal day at work and your favorite store is having a sale and you just really want to treat yourself. You cannot build $1 million habit on a feeling that comes and goes. You have to build it into the architecture of your financial life so that it happens whether you feel like it or not. Set up the automatic transfer today, not this weekend, not when you get your next paycheck. Today. Pick an amount that is honest for your current situation. Not aspirational, not impressive, just honest. And set it to transfer automatically on the day your paycheck hits your account, before you see it, before your brain registers it as money available to spend. The investing happens first, and then you build your life around what is left. The psychology behind this is something behavioral economists call paying yourself first, and the research on it is overwhelming. When saving is automatic, people save significantly more over their lifetimes than when it requires a conscious, active decision every single month. Because every month that requires a conscious decision is a month where life can get in the way, where the car needs a repair, where a friend's birthday comes up, where you had a hard week and you just want to do something nice for yourself. Automation removes all of that friction entirely. The decision is made once, and then it just happens forever. Rule number 2. Start with whatever number is real and increase it every single time your income goes up. One of the most common mistakes people make when they finally decide to start investing is waiting until they can invest a real amount. They think $50 a month is too small to matter. They think $100 is not serious enough. They are waiting until they can put in $500 or $1,000 a month before they start, and so they never start at all because that number never quite feels achievable yet. Here is the truth. The amount matters far less than the habit. A $50 automatic monthly investment started at 25 is worth more than a $500 manual monthly investment started at 40. Not just financially, though the math absolutely supports that, but psychologically. Because the person who started at 25 with $50 has built an identity around being an investor. They have internalized it as part of who they are, and that identity makes it natural to increase the contribution as their income grows. The person who waited until they could do $500 is still treating investing as something external to themselves, something they do when the conditions are right, rather than something they simply are. Start with whatever is honest right now. $25, $50, $100, it does not matter. What matters is that you start, that it is automatic, and that you commit to one rule. Every single time your income increases, you increase your automatic contribution before the lifestyle has a chance to absorb the extra money. A raise comes in, and you immediately redirect at least half of it into your investment account before you get used to spending it. That single discipline, practiced consistently over a career, is how ordinary incomes become extraordinary net worth. Rule number 3. Stop watching the market like it is a scoreboard and start treating it like a slow cooker. This rule is about managing the relationship between your psychology and your portfolio. Because here's what nobody prepares you for when you first start investing. Watching your account balance go down feels absolutely terrible. It triggers a real physical stress response. Your brain reads financial loss the same way it reads physical danger. And when the market drops 20% or 30%, which it does regularly as a completely normal part of how markets work, everything in you screams to do something, to take action, to protect what you have left. And that instinct, followed by millions of investors simultaneously, is precisely what destroys long-term returns. They sell at the bottom. They lock in the loss. They sit in cash while the market recovers. And they re-enter only when it feels safe again, which is usually near the next peak, just in time for the next correction to hit. Morgan did not do that. Not because she had nerves of steel or some special emotional detachment from money, but because she set up her investments and then deliberately stopped paying close attention to them. She checked in maybe once or twice a year. She rebalanced occasionally, and she had internalized one truth deeply enough that it held her steady through every storm. The market has recovered from every single crash in its history. Every single one. The 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic collapse. Every time, without exception, it came back. And the people who stayed in collected the recovery. The people who panicked and left missed it entirely.